A major financial system is failing. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, policymakers are scrambling as a major banking system teeters on the brink of total meltdown. And I want to understand why this is so critical, because at the heart of every debt-based economy is the banks. And as we learned during the global financial crisis, when the banks go, well, everything goes with it. Plus, we have a sponsor for today's show, Black Box Stocks. I'd like to introduce you to them. They're on the NASDAQ under the symbol BLBX, and they just made a major acquisition that's getting the attention of a whole bunch of investors and big money, because this is going to drive a tremendous amount of revenue into this firm. And this is an early opportunity for you, because I'm going to make the case of why their stock is soon to go up as much is 32%. Stay tuned to the end of the show, or check out the pinned comment or description below for more information. Again, they're on the NASDAQ under the symbol BLBX. And here's our headline for today: as China merges hundreds of rural banks as financial risks start to mount. And when you start to hear that a banking system is having problems, regardless of how good the economy may be doing on the outside, when the banks go, everything goes underneath it. And this is a big problem, because we've talked about in China how the property developers were insolvent. And if they're insolvent, well, that means the banks are insolvent. Well, sure enough, we're finding out it's now far worse than even we thought. China's banking industry has been weighed down by a litany of troubles over the past years, including a deepening slump in the real estate market and overall fragile economy. The 2,100 banks in the rural cooperative system saw their bad loan ratio stand at 3.48% at the end of 2022, more than twice as high for that of the whole sector. And that is a huge problem, because when banks have bad loans and you get into a slowing economy, which will look more at what's going on with China right now, well, it means there's a potential that those bad loans are going to go into insolvency and then the default. And next thing you know, yank all the banks down one by one as investors start to panic. It's why the risks are the most concentrated among the smaller financial system, so China is pushing the reform at a faster pace. Now, I want you to think, here in the U.S., the small and mid-sized regional banks are insolvent. So what's happening in China could come here to the U.S. at some point. The question remains, will this work? Well, I'll make the case why it probably won't. And here we can see one key solution resolving the risk is through mergers and reorganizations. Now, you want you to think back to the global financial crisis, because how did everything get set off? Well, they took bad loans, mortgages that should have never been originated because it was questionable if people would ever be able to pay on those loans, and they packaged them with good loans and sold them as bonds under the notion that, well, maybe a couple will go bad, but not the whole thing. Well, this is the same idea. Let's consolidate all the bad stuff together, and maybe there's enough good stuff to keep it going. The problem will come back to, if China's economy enters a recession, or even worse, the world economy enters a recession, there's no hope that even these consolidated banks will remain standing. And we're left with only a toxic tale of significantly smaller institutions. And while the contagion risk across the financial system seems limited, well, at least for today, these lenders can be very disruptive with their specific regions should they blow up. And that's exactly what happens, because in a debt-based economy, we know the commercial banks create new money. And so all of a sudden, if banks start to go under, we've seen the panic here early back in March of last year. What happened to depositors when they thought their banks were not going to give them their money? Everyone went into panic mode, spending stopped, everything changes. This is, again, a big problem for China, who appears to be trying to get ahead of the story. The problem is, it's not going to work. As the government has since authorized 7 provinces to consolidate over 500 smaller lenders through either mergers or shareholding structure, this according to Bloomberg. And while the mergers create bigger financial institutions, they aren't necessarily stronger. That is the case here, because the transactions weren't always done in a market-oriented approach, and simply saying that these banks have a lot of bad debt on their books, and all we've done is taken a bunch of small banks that maybe if some of them will fail, but not all of them, and And we put them in the same situation now where one entire bank, made up of a bunch of small ones, are going to have a problem and likely fail. Now, the notion that this can happen here in the U.S., well, let's take a look at some U.S. data here in the banking system, because there is a problem. In a debt-based system, you need the constant creation of new money through new loans to pay on the old debt. And that's what keeps the system going. It creates growth and it pays on debt. And one of the problems now here, at least in the US, and we can say the same is likely true in China, because you wouldn't go through and consolidate your banks if nothing was wrong. We can see commercial industrial lending, based on the recent weekly data, is contracting at 1.7% per year. And at the beginning, this looks pretty small. The challenge here, again, comes back to what happens when there isn't enough money being created to pay on all the existing debts. Well, everything starts to point at the banks. And now, when we look further at China, you see the problems are much worse. As China's factory activity shrinks, as growth hurt by weak demand, and that is the big threat here, is what if China's economy enters a recession? Well, it's teetering on the edge of that. As we know, they're desperate to get their property developers turned around, because that means they can get the banks to be in a solvent position. The issue here, the global manufacturing sector is in trouble, and so too is the global economy. As we can see, based on the official Manufacturing Purchasing Managers Index, it rose to 49.2. Of course, that means it's still below the 50 mark that separates expansion from contraction. And all this means is Chinese factory sector contracted at a slower pace than last month. The problem is it's still in contraction. As a non-manufacturing or services gauge, measuring the activity in construction and services did rise to 50.7, so indicating an expansion over the prior month, which was marginally better than what analysts projected. A sub-indexes of services activity expanded for the first time since October, though growth in construction eased to a 3-month low, suggesting, remember, where the manufacturing sector goes, the services sector does eventually follow. This is a problem, because when we look at where lending is headed in China, well, we can look at the U.S. data and we can figure out real quick that things for Chinese banking sector is going to get a lot worse. And here we can see the commercial industrial lending data shown on a year-over-year rate of change against the current business general activity index for the Philly Fed in red. And what we can note is the manufacturing sector leads downturns in commercial industrial lending every single time. And so we can note that how heavy of borrowers the manufacturing sector is and how they create the growth in lending, and then the rest of the economy follows suit. And we can see here in the US, a contraction in manufacturing activity is indeed weighing down on commercial industrial lending, which is a big problem for China, because their manufacturing sector is still in a contraction. And that means, again, not enough new money being created to sustain economic growth. At some point, some of the bricks on this wall start to fall off, and the next thing you know, the foundation crumbles underneath. And there's no signal of a turning point here. The surprises are too small to change what is already a very entrenched bearish view on the outlook, suggesting, as we've been making the case, the Chinese economy is indeed headed toward a recession, and attempts to consolidate the banking industry to give people confidence will only be transitory in the bigger picture of where their banks are headed. The problem is the U.S. banks are headed in the same exact path. But the problem with China managed to be even bigger as their home sales slump persists after Evergrande liquidation. Many people were hoping that Evergrande going into liquidation would give buyers confidence, not a chance, because what they're now wondering is the home I bought from Evergrande ever going to be completed? And even worse, let's say I go buy something from someone else. Well, are they on the brink of liquidation and taking my money with them? The value of new home sales from the 100 biggest real estate companies slid a whopping 34% from a year earlier, following a 34.6% decline in December. Get this, January sales were down 48% from the previous month, a record low seen in recent years, suggesting that Chinese consumers are not buying homes here. That means they're not creating new money through the banks. That means the property developers one by one, are likely headed into liquidation, and it doesn't matter. You can keep consolidating your banks all you want. You cannot stop the trend now, and it's getting very clear because the property downturn has been a major headwind for China's economy, ratcheting up pressure on developers that are struggling to repay debts. There's a key part. You need new money. You need buyers to come in here to pay on those debts, and more importantly, get these projects completed. China Evergrande received a liquidation order from a Hong Kong court on Monday, making the largest collapse in a 3-year real estate crisis. Meanwhile, authorities recently called on local governments to back developers' financing needs, including drafting a list of projects eligible for funding. Some financial firms even stepped to the plate and are responding, with Ping An Bank putting 41 developers on a list of builders eligible for support. So again, this comes back to let's give some more bad loans to these property developers in hopes that Chinese consumers buy. You can see that rate cuts now from the PBOC are only a matter of time, and a bunch of fiscal easing is coming because their economy is headed down and they can keep consolidating the banks. It's not going to make any difference. But here the problem is, as we now look toward the U.S. data, we know that our banks, our small and mid-sized regional banks, are also insolvent. The question is, can our economy hold up? Well, it doesn't look like for a whole lot longer. As U.S. hiring and wage growth slowed in January, this from ADP data, as private payrolls advanced 107,000, which means now the trend is slowing, and that's exactly what we should expect. We'll have, of course, the official non-farm payroll report on Friday, but the key with these payroll reports doesn't not matter that they're positive. What matters is the trend. As we've noted in the past, they can still show positive wage growth even though we're in a recession. It's when they go negative. Well, watch out. Things get much worse. As private payrolls increased 107,000 in January from a downwardly revised 158,000 gain in December. While hiring has slowed, it was broad-based across industries and regions, signaling demand for workers remain healthy. Now, I would argue that if the trend in payroll growth is slowing, the demand for labor does not remain healthy. That's exactly the opposite, because we know officially there are 1.833 million Americans on a seasonally adjusted basis that are on continued unemployment claims, around 2 million if you go on a non-seasonally adjusted basis, suggesting there's still a big pool of workers available. If the economy was booming, well, we'd see a lot of them be hired. We're not seeing that at all. Even worse, nominal wage growth continued to slow. And let's take a look at that, because that just means that the labor market is on the verge of breaking out in the wrong direction. Of course, we know the political elites don't want to see this chart, but when you look at total compensation, which is average hourly earnings multiplied by average weekly hours of production of non-supervisory employees, they're shown in blue on a year-on-year rate of change against continued claims. As you see a deceleration in total compensation, well, what happens? You see a corresponding increase in people on unemployment that are stuck on unemployment. And you see that trend repeat over and over and over again. Now the problem is, look at total compensation growth. It's slowing, and it's continuing to slow. Of course, we'll get, again, the official data on Friday, but this is a challenge for the U.S. economy, because if we continue to see more people end up on unemployment, that means they have less money to pay their debts. That puts a massive amount of stress on the small and mid-sized regional banks, which you can only now wonder, will the Fed's next move be to consolidate them? Because U.S. labor costs gauge cool, a sign of easing inflation. This from official government data, as the employment cost index increases now at the slowest pace since 2021, validating what we know is that wage growth is slowing. And when consumers have less wage growth in still a relatively high inflationary environment, they don't have enough money to go out and consume. The less they consume, that means that employers then turn out and let people go because they just don't have the demand. And the cycle continues to move slowly until it increases at a faster and faster rate, and then it gets out of control. And the employment cost index, which measures wages and benefits, increased a mere 0.9% in the fourth quarter, the smallest advance since 2021 after rising 1.1% in the prior 3-month period. So now we know there is a definite link between wage growth and unemployment claims. Now remember, we're going to hear from Fed Chair Powell later today, or we actually did hear, we didn't cover it on the show due to early filming, and they're going to talk about how robust the labor market is and how there's strength there, and they're relying on it. They just can't see that total compensation growth is slowing down, and that is not what they need at this time. The easing of wage pressure is consistent with inflation that's largely been receding faster than anticipated, while a slowdown in hiring raises downside risk for the labor market in coming months. And it makes perfect sense. When people have less money in terms of their wage growth, well, they don't spend as much, and that means if prices go up, which we know they have been, then indeed demand falls. And sure enough, when we look at total compensation, still shown in blue, now against the consumer price index in red, what we can see is where total compensation growth goes. Well, inflation is likely to fall, suggesting to us, again, as we look forward to the official data on Friday, that indeed demand is going to continue to decline, inflation is going to come down, and it's only going to be a matter of time before we start to hear about central bankers needing to cut rates. And one place that they could be cutting soon, well, is Germany. As German prices ease more than expected, feeding ECB cut hopes, here we can see inflation drop to 3.1% from projection at 3.2%, on their way to the 2% target that seemingly every central banker has. And inflation is absolutely moving in the right direction, highlighting this from President Joachim Nagel said late Tuesday, highlighting that core price pressures remain too high. Yes, we agree with that. Energy costs are volatile. Well, that's a given. But future wage growth is uncertain. Well, it's not if there isn't demand. If your factory sector is indeed contracting, the next thing you know, your wage growth is going to come down. This is an issue around the world. We're seeing with higher unemployment claims, things are going the wrong direction. But one place they're going the right direction for is that is of our sponsor, Black Box Stocks. You can find them on the NASDAQ under the symbol BLBX. Now, I want to show you who this company is, but they just made a major acquisition. The path of this company is starting to change. This is an early opportunity to jump on board with them, because I'm going to show you why I think their stock is going to head up as much as 32% in the near term, as a lot of investors are looking at what they're doing and they want a piece of it. Now, they are a financial tech company. Let's head over to their website here. Again, everything in the pinned comment description below with real-time analytics for traders. So maybe you're not a trader, but you want to invest in a company who's doing that. Well, they have proprietary features with powerful alerts for their subscribers, with their fully automated algorithm-based system that scans over 11,000 stocks multiple times per second. Not only that, they have options flow with their scanner that tracks large aggressive buying activity in specific option contracts and looks for unusual options activity to give you the edge as a trader. And plus, they have a whole trading community, so that way you don't have to trade alone. But let's say that you want to invest and you're not a trader. Maybe you are and you want to be in a company that's doing that. Well, Black Box is the answer. Again, on the NASDAQ under symbol BLBX. But what's really getting the attention of the markets right now is the major acquisition they just did. You're not going to believe this. Check this out. They signed a definitive agreement to acquire EV Tech Aluminum, a supplier of proprietary parts for the EV, hybrid, and performance automotive market, which projected revenue of $52 million for the fiscal year ending June 30th, 2024. So all of a sudden, this company is going to see a massive influx in revenue, and that's getting the attention of a lot of investors, as EV Tech is a supplier of proprietary mission-critical parts for hybrid, performance, and luxury OEM automotive brands, including Jaguar Land Rover, Aston Martin, Ford, Bentley, and auto suppliers including Dana, American Axle, Cox Powertrain, and among others. David Roberts, a 40-year veteran of the global automotive market and UK export ambassador, leads a team of seasoned executives with decades of experience. This is going to be huge, and let me show you why. Because it's not just the fact that you have access to dark pools and trading stuff. You're now a big investor in the EV tech space, and here you can see investors are liking this move in a big way. If we look at the 6-month chart here, and what we can see is the supply zones are drawn in. You can see where buyers have previously been at down here below. And how do you know that? Because as it gets into that zone and stocks go up, there's a small overhead sell zone here that every time I got up there, sellers showed up. But look what happened now. all of a sudden the stock took off to this higher level that it's even been at an even higher level than that. And now you can see it's making a rally here. The RSI is building momentum. The MACD is building momentum. And what did it do? It pulled down right into this volume profile line and it found buyers here. That sets out the move to retest the initial supply zone and then break out what we think is a 32% move to that upper one. And as we zoom in, of course, you can see it very clearly that the trade set up for this stock price is outright bullish. You can see again, it came down the supply zone. Buyer stepped in, drove it not through one, but up to two supply zones, pulled back, and guess what? The buyers moved up their line. You can see the volume profile there, setting up again that 32% move to the upside for black box stocks that's making waves all of a sudden and could be with future news flow. So maybe some even more exciting things coming out of this company. You definitely want to check them out. And again, on the NASDAQ, under symbol BLBX. But as always, with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.